Okay. Thus far in Chapter 6, we've talked about the basics of internal control principles. And then we kind of skipped to the end of the chapter and discussed the bank reconciliation, which you've got a demo problem for. The other piece of heavy lifting in this chapter, the other thing that I want you guys to know from a quantitative standpoint, is the establishment of a petty cash fund. All right. So when we think of what we've learned in Chapter 6 thus far, one of the takeaways should be that it's usually not very easy to get cash out of a company, right? Because of internal controls, they like to make payments by check. Well, the reality is that oftentimes business isn't done that way for many types of transactions, all right? And so businesses need the ability to do some transactions on a cash basis, and that's what petty cash funds do. All right. Now, so we're going to look at exercise 6-5 that we see here. All right. And we're going to use this to illustrate the establishment, replenishment, and then increase of a petty cash fund. All right. And we'll take it piece by piece. So let's just start. This will be Waupaca Company establishes a $350 petty cash fund on September 9th. All right, the problem goes on. Let's stop there and let's see what the problem is asking for us to do. All right, so it says prepare the journal entry, the September 9th entry to establish the fund. All right. So let's talk a little bit about what that establishment of a petty cash fund looks like. So it starts not unlike any other payable. So a request would be made to accounts payable to establish a fund in the amount of $350, and a check would be cut, made payable to whoever is going to be responsible for the $350. So anytime you have a petty cash fund, you have a petty cash custodian, right? And that person is going to be responsible for that $350. The check would be made payable to that person, all right? So since we're writing a check, we're going to credit a cash account, all right? And the cash is still company property. It's just being put into a different type of cash account that we'll label petty cash. All right. All right, so the petty cash custodian is going to get a check. They'll take it to a bank and cash it and put it in a lockbox, usually locked in an office drawer somewhere. All right. Now, oftentimes with petty cash, oftentimes they function as the office slush fund. There are legitimate transactions that you'll see as well. But oftentimes, when Doris turns 55 and, the office buys a cake and some balloons, that goes through petty cash. Or Taco Tuesday, or management wants to bring in pizza on a Friday, all right? Those types of things are ran through petty cash, right? When pizza guy shows up, they don't like it when you tell them, okay, we'll send you a check in 4 to 6 weeks. They generally want cash. All right. Other types of transactions we'll see postage, and basically whatever the company needs to pay for in cash. Okay, that's the September 9th entry. Let's look back to the problem. All right. It continues on September 30th. the fund shows $104 in cash. So in the lockbox, there's $104 remaining, along with receipts for the following expenditures: transportation in, so some shipping was paid for; postage, so somebody went to the post office and mailed some documents; miscellaneous expense, and that's probably where your Taco Tuesday falls. All right. And it does tell you the petty cashier could not account for the $3 shortage. All right. So what we want to think about these is these are expenses. So we do need to record them, right? Because they've happened during the month of September. We need to record these expenses. All right. And so transportation in, that's a cost paid to get inventory on site. All right. You may recall from chapters 4 and 5 that when you pay for transportation in, that's in merchandise inventory. Or we increase the inventory account. All right. So that's the inventory asset. Postage expense, $123. Miscellaneous expense, $80. All right. So what happens on September 30th is reimbursement. That's what number 2 asks for. The September 30th entry to reimburse the fund. All right. And so that's the time when we record the expenses, when we reimburse the fund. Now, what this looks like is actually another voucher package or group of documents sent to accounts payable. And they're going to cut another check, and this check needs to bring the fund back up to $350, right? Because that's what the fund was established for, right here. All right, so I'm going to set up a T account to kind of help us here. All right, so petty cash started with $350. All right. Now, as the month progressed, transactions were made and cash was paid out. And the job of the petty cash custodian is when a transaction occurs, they need to stick the receipt in place of the cash spent. All right. So let's go ahead and reduce the petty cash account for the cash expenditures. All right. Now, this particular problem tells you there's a $3 shortage. All right. Not every problem will tell you. Sometimes you have to figure it out, which is why I put the this T account up here. So you guys know how to compute the balance in the account. We'll add the debit, subtract the credits. All right. And we get $107. That's what's in the lockbox. Or that's what should be in the lockbox. The problem tells us there was 104. All right, which means there's a $3 shortage. All right, and let's go ahead and put that shortage in here. Actually, undo that. My computer is dragging a bit. That wasn't what I wanted. All right. This lag is screwing things up. It's okay. Um, all right. So when we plug in the $3 shortage, that's how we get to the 104. Now, the check cut needs to bring the petty cash balance back up to 350. All right. So $350 minus the 104. All right, which gives us $256, and we need to plug the other three for this journal entry to balance, and that is an account that we'll call cash over and short. All right, which is kind of a plug. It can be debited or credited depending. For instance, if there was too much money in the lockbox, doesn't happen a lot, but I believe there's a problem in the homework where it does in fact happen. All right, so that could be a debit or a credit. It's whatever's necessary to balance the account, make debits equal credits. All right, and that functions. In this case, it functions like an expense. All right. Okay. And so after this entry, we would have a check and $246 in cash that's going to be deposited back in the petty cash account. And now, once again, we've got $350. All right, and that's how the fund would be replenished. And typically, this would happen at a stated interval, be it monthly or every 2 weeks or whatever the company's policy is. All right. Let's look back to the problem. The last thing it has, October 1st entry to increase the fund to $400. All right. So the following day, the company wants to increase the fund, and actually let me throw a description in here. All right. Now, the entry to increase the petty cash fund looks just like the entry to establish. All right. Going to debit petty cash, credit cash. We want $400. Now, the fund already has a $350 balance, so we just need to increase it for the difference. All right. And that's all that there is to this problem. All right, to increase petty cash fund balance. All right, and that's what that third entry does. So that's basically what you need to know as it relates to petty cash. I'm going to post a handout. In fact, I have posted a handout. I'll give you an opportunity to work through this on your own, and I'll give you guys a solution on Monday. All right.